The real cost of that daily coffee, a financial wake-up call. Let's start with a simple question. How much do you spend on your daily coffee each week? Seriously, think about it. That latte, that iced coffee, that quick espresso, how much does it add up to? For many people, it's a small expense, easily dismissed. But what if I told you that seemingly insignificant daily habit could be silently eroding your financial goals over time? This isn't about judgment. It's about understanding the power of compounding costs and making informed decisions about our spending habits. We're going to build a detailed scenario, a what-if, to illustrate just how much those small, regular expenses can actually cost you. We'll break down everything from immediate impact to long-term consequences, giving you practical tools to take control of your finances and see the bigger picture. Let's call our protagonist Sarah. Sarah is 28 years old, works as a marketing assistant in downtown Chicago, and earns $65,000 per year before taxes. She's responsible, generally good with her money, but she's also prone to small, impulsive purchases like that daily coffee. Let's assume Sarah buys herself one $5 latte every workday. That's 5 days a week, totaling $25 per week. Now, let's calculate the annual cost. $25 week, 52 weeks year equals $1,300 per year. That might not sound like a huge amount, right? But hold on, this is just the starting point. We're going to layer in some additional factors to truly understand the impact. Let's look at how inflation plays a role. Inflation, simply put, is the rate at which prices for goods and services increase over time. The U.S. Bureau of Labor Statistics tracks inflation through the Consumer Price Index, CPI. As of late 2023, the CPI was hovering around 3%, meaning that the cost of things like coffee and everything else tends to rise by roughly 3% each year on average. So if Sarah continues buying her $5 latte every day for the next 10 years, let's factor in inflation. We'll use a conservative estimate of 3% annual inflation. This isn't a guarantee, but it provides a reasonable benchmark for our calculation. Year 1, $1,300. Year 2, $1,300. 1.03 equals $1,339. Year 3, $1,339. 1.03 equals $1,379.17. Year 4, $1,379.17. 1.03 equals $1,421.55. Year 5, $1,421.55. 1.03 equals $1,464.20. Year 6, $1,464.20. 1.03 equals $1,508.13. Year 7, $1,508.13. 1.03 equals $1,553.37. Year 8, $1,553.37. 1.03 equals $1,600.01. Year 9, $1,600.01. 1.03 equals $1,648.01. Year 10, $1,648.01. 1.03 equals $1,703.45. The total cost over 10 years, accounting for inflation at 3%, is approximately $17,034.50. That's nearly $17,000 spent solely on daily lattes. It's a staggering figure that highlights the power of consistent small expenses. Now, let's consider what Sarah could have done with that money. Let's assume Sarah invests that $17,034.50 annually into a Roth IRA, individual retirement account. A Roth IRA allows your investments to grow tax-free, meaning you don't pay taxes on the earnings when you withdraw them in retirement. The average annual return for a diversified stock portfolio over the long term is around 7%. This is a historical average, and investment returns are never guaranteed. Let's use that as our conservative estimate. We can use a compound interest calculator to see how $17,034.50 invested at 7% annually for 10 years would grow. The result: approximately $48,698.92. That's over 4 times the amount she spent on coffee purely from investing what she would have spent on a daily latte. This simple illustration demonstrates the incredible impact of compounding returns. It's not just about saving money, it's about letting your money work for you. Now, let's dig deeper and explore some other factors that contribute to this seemingly small cost having a significant impact. Let's talk about opportunity cost. Opportunity cost is defined as the value of the next best alternative when making a decision. When Sarah spends $25 on a latte each day, she's not just losing $25. She's also foregoing the potential investment returns or other valuable experiences that money could have provided. That $25 could be put into savings, invested, or used for something meaningful to her, perhaps a vacation, a new piece of equipment for her job, or even paying down debt. Let's consider another scenario. Sarah decides to cut back on her daily coffee and start saving that $25 per week instead. Over a year, she saves $1,300. If she invests this money at 7% annually, compounded over 10 years, she'd have approximately $38,643. This is significantly more than the $17,034.50 she would have saved if she continued buying coffee every day. The difference between saving and spending, especially on seemingly small purchases, can be dramatic. Now let's examine the psychological aspect of this habit. Small, frequent expenses often don't trigger a strong emotional response, making them easier to justify and harder to cut back on. These are often called small indulgences, and they can quickly add up. The feeling of treating yourself is powerful, but it's important to be mindful of the long-term consequences. Behavioral economics demonstrates that people tend to make decisions based on heuristics, mental shortcuts, rather than rational analysis. In this case, the small pleasure of a daily coffee might outweigh the cognitive effort required to resist the urge. Let's introduce another variable. Sarah starts buying a fancy, imported espresso drink for $8 instead of the regular latte. This increases her weekly expense to $32 or $1,664 per year. If she still invests this amount at 7% annually over 10 years, she'd accumulate approximately $95,000. The impact of even a slight increase in spending can be substantial due to the power of compounding. It's also important to recognize that these numbers are just estimates. Actual investment returns will vary depending on market conditions and the specific investments chosen. However, the underlying principle remains. Small, consistent expenses, compounded over time, have a significant impact on your financial well-being. Let's look at some strategies Sarah can employ to combat this habit and build better financial habits. Firstly, track her spending. Using budgeting apps or even a simple spreadsheet, she can meticulously record every coffee purchase for a month. This awareness is the first step towards changing behavior. Seeing the actual numbers laid out in front of her will likely be a powerful motivator. Secondly, identify triggers. What circumstances lead Sarah to buy a daily coffee? Is it stress, boredom, social pressure? Once she understands her triggers, she can develop strategies for coping with them without resorting to impulsive spending. Perhaps she could switch to making coffee at home or find alternative ways to manage stress. Thirdly, set realistic goals. Instead of trying to eliminate the daily coffee completely, which might be too difficult, Sarah could aim to reduce her consumption gradually. For example, she could start by limiting herself to 3 days a week. Small, achievable goals build momentum and increase the likelihood of long-term success. Fourthly, explore alternatives. There are many affordable ways to enjoy a treat without breaking the bank. Perhaps she could switch to tea or try making her own coffee at home, which would save her money in the long run. Finally, automate savings. Setting up automatic transfers from her checking account to her Roth IRA each month ensures that she consistently invests, regardless of her mood or current financial situation. This pay-yourself-first approach is a cornerstone of successful investing. Let's revisit Sarah's initial $17,034.50 spent on coffee over 10 years. Now let's consider the potential for debt, specifically credit card debt. Let's say Sarah occasionally uses her credit card to cover the cost of her daily coffee when she's short on cash. If she only pays the minimum balance each month, interest charges will accrue, significantly increasing the total cost. The average credit card interest rate is around 20%. This is a very expensive way to finance purchases. Let's assume Sarah carries a $100 balance on her credit card and pays only the minimum payment of 3% per month. This would result in substantial interest charges over time, drastically increasing the overall cost of her daily coffee habit. The compounding effect of interest makes debt a particularly dangerous financial trap. In conclusion, the seemingly small expense of a daily coffee can have a profound impact on your long-term financial goals. The principles illustrated here, inflation, compounding returns, opportunity cost, and behavioral economics, apply to countless spending habits. By becoming aware of these factors and taking proactive steps to manage our finances, we can avoid falling into costly traps and build a more secure financial future. It's not about deprivation. It's about making conscious choices that align with your long-term aspirations. Don't underestimate the power of small changes. They can add up to significant results over time. Remember, every dollar saved or invested is one step closer to achieving your dreams. Now let's look at some related search terms you might be interested in: compound interest, Roth IRA, inflation calculator, behavioral economics, budgeting tips, financial planning for millennials, saving money habits, opportunity cost examples, small expenses, big impact.